Oh, he's too harsh with himself.
I'm a bit surprised.
Let me just pause there real quick.
I'm Sharyln. I'm 40 this year. I'm actually in the beauty business.
Hi, I'm Bryce. I'm 31 years old this year. I've been working for over 5 years. Currently, I'm in the publishing industry as a content editor.
Alright, first we have Bryce.
My retirement goal will be to retire by the age of 65. I definitely hope to travel in my retirement years, but only if my health allows for it. For retirement, I think for the current situation, we would need about 5,000. In the future, after inflation, I'm not very sure how much exactly we would need.
He understands inflation. So inflation is a very important aspect to think about when it comes to your retirement.
So right now it's probably a bit hard to say whether 5,000 is good enough. And that's why in order to beat inflation, it is important to plan. It is important to grow your money at a rate that is above inflation.
Right now, my current financial priorities would be saving up for the house, renovations, as well as the wedding. So I would most likely take a HDB loan, the 30-year loan, and I will definitely be just paying it through CPF.
I think he's gone for a HDB flat, and by the time he would be about 62. So this is very good because one of the main things about retirement is that you should have a fully paid house.
So I'm roughly putting in about 20% of my savings into ETFs, but I'm also saving about 33% in liquid finances. Other than ETFs and my cash savings, I do have a few unit trusts as well. For those, I use cash and not CPF.
Definitely investing 20% of your income is a very good step for someone at his age. But at the same time, he must be willing to stomach the losses that would happen in the near term.
For his age, actually he can afford to take quite a lot of risk for long-term goals. And in this case, it's a long-term return.
So I think he brought up an important point here, which is around not touching his CPF for investing, because you actually get a pretty good return on your CPF savings. And ultimately it's meant for retirement, so you don't want your retirement nest egg to be affected in the event of a recession or a downturn.
As of right now, my savings are all lumped together into one. After I get married and stuff, then we will start to separate it into retirement planning savings and normal savings for rainy days and stuff.
Overall, that makes sense in the long run because there should be two pots of money. One is for the future and one is for immediate pressing needs. For example, your renovation, your home loans, your wedding, your travel, those kinds should be your liquid savings, and then you have your retirement nest egg.
I believe that maybe 50% will come from CPF. The rest may be funded from my investments. Maybe I will get some annuities along the line. I do see CPF as important other than the fact that it's helping me finance my flat. CPF Life gives me a base where I can work on to build my income from there. If I do have excess cash lying around, I definitely would think of topping up because the interest rates there are definitely much better than what you can get outside with little to low risk.
When it comes to retirement planning, for Singaporeans, the base of our retirement planning should be the CPF Life payout. And the CPF Life payout can be about $2,000 in today's terms if you top it up to the max. Investments in general should form a second layer of additional income for persons who need more than the CPF Life payout. So on topping up, that's a good idea for young people to start as soon as possible.
So in a normal bank account, especially now when the interest rates are pretty low, it's actually at 0.05% per annum. But now with the CPF, OA or SA, you get between 2.5% all the way up to 5% for your SA.
And the earlier you top up, the more you can have the impact of this compound savings, compound interest. And in fact, it is no risk. It's backed by the Singapore government.
You need that basic retirement sum. Right now it's at $90,500. 30 years down the road, it's going to be close to $200,000 if you factor in an inflation rate of 3 to 4%. So the earlier you start, the better. $7,000 you top up to your CPF today is going to be worth $21,000 30 years down the road. That's purely math. I hope on the other side of this camera, if you are listening to this video, you would do that.
In the future, definitely I would think of going into maybe getting a second property, maybe doing some commercial property as well. But it still depends on the market situation and the amount that I have in the future itself.
I would say that let's get the basics right, and the basics means good financial health, savings and all that, getting your good insurance coverage, and then thereafter put aside a little money every month into investments and then topping up your CPF. And along the way, if you feel that you have the funds to be able to buy a second property, then that will be an additional effort.
One thing I would suggest to him is to look at REITs as well. So you don't actually have to buy the whole property. So for REITs, you can start with as little as $100 through a regular savings plan. Or you can actually build up your investment amount. For example, in $100,000, you can actually get $7,000 of yearly dividends. So that could again supplement your CPF life in the future.
On a scale of 1 to 10, I would say about 3 or 4.
For now, my priority still lies with my flat and my renovation, as well as the wedding.
Oh, he's still harsh with himself.
I'm a bit surprised because it seems that Bryce has it quite together.
I would think that his thinking is definitely more like a 7 or 8. He has a good base. He just needs to build on that base and actually do the actions that he needs to do to get that retirement life he wants.
For now, because I don't have any financial commitments, the only issue is when something happens and it's a rainy day, then I have to fork out emergency funds. Other than that, it's fine for me.
This is why we always recommend that you have an emergency fund of about at least 6 months, just in case you lose your income. Because if you do not have this emergency fund of 6 months, what happens is that you have to start dipping into investments to fund your lifestyle, and that can actually hurt your long-term goals.
It's important that you have insurance premiums as part of your rainy day funds. The moment you let your insurance lapse and you don't pay your premiums, you lose that coverage, and it could be difficult for you to reapply to get into the coverage again.
In this period where there is a pandemic, I'm pretty sure there are a lot of people who have insurance plans and some of them may not be able to afford due to the loss of jobs, retrenchment and stuff. Is there anything that the companies are doing that can help them tide through this period before they can pay back whatever they own?
When you can't afford to pay, you can actually reach out to the insurer, and there could be things like a premium holiday for you to get on.
The other thing about insurance is that in Singapore, MoneyOwl finds that many of us pay too much for insurance but actually don't get very much coverage. So one thing is really to look at restructuring your insurance. There are several things that you can do. If you have a whole life plan, the premiums tend to be quite high. You could discuss putting it into a paid up position. Paid up means that you don't pay any more, but the insurance company will calculate what is the sum assured that you can already be entitled to based on your cash values. The other way is really to look at whether you can replace this whole life plans, the more expensive plans, with a low cost term insurance that can give you the same coverage at very much lower premiums. So this is something that Bryce should look at together with an advisor, because it is not a decision we taken lightly. You might lose coverage if you have some pre-existing medical conditions.
I prefer more liquid investments rather than locking it up in a savings plans. So is there anything I can do more that can help me towards my retirement goals?
He needs to find something that yields him a better return than a 2%, 2.5%, or up to even 5%.
So indeed, the more liquid instruments would be investing in markets. So that would be stock shares or funds that buy stocks and bonds. But I would also caution that we should not regard investments as sort of guaranteed, and that's why your time horizon is still very important.
Personally, I have a liquid stash, and I also have an illiquid stash, which is a large chunk of it is in my CPF, because I know that 30 years down the road, it's going to be worth 3 times more than what it is today. So it's better for you if you actually just save it up and put it in some place that you can't touch for 30 years, and ultimately is yielding you a very good risk-free return rate of maybe 4 to 5%. All right, now on to Sharyln.
I'm Sharyln. I'm 40 this year. I have 2 kids. They are 16 and 12.
But she looks quite young. Doesn't look like a mother of 2, but probably will cut that out.
I'm actually in the beauty business. My retirement goals are, I wish I can leave the rat race at the age of 55. I wouldn't say that I'm going to stop working. Probably have engaged someone to run the business for me and I just take the advisory role. I'm actually very simple. I just wish that I can travel overseas once a year. Considering the inflation, right, I think I will probably need about 5,000 per month. If medical bills or annual health check can be covered under some insurance or policy, then I think that 4,000 a month would be enough.
So indeed, for retirement, we always say that there are three must-haves for retirement. One is a regular stream of income to fund your living expenses. The second is a good medical expense insurance to cover hospitalization costs and chronic illness costs. And the third is actually a fully paid house and you don't have to worry about rent.
I think she's quoted two numbers, $4,000 and $5,000. I believe that you should always add a very huge buffer to that, again because of inflation and unforeseen circumstances that she may have to go through in her 20 years before retirement age. I would think add another 20% to that, maybe try to aim for $6,000 in your retirement years, and let's say CPF Life covers $2,000, then you need to supplement it by $4,000 of your own passive investments or your rental income or your dividend income, things like that.
Last year, finally I get a chance to start my own beauty salon, which is Sharyln and Co. I wouldn't say that on a personal side I could save any actually at the moment, because whatever I earn, right, I reinvest back into the business because I want the business to grow so that long term I get to enjoy the benefit.
It's a very classic SME approach right there.
The business is everything. They want to plow everything back into the business.
So it's important for her to understand that you must also protect yourself as a person who is running the business and you have your own mouths to feed at home. So she should also have a rainy day fund set aside for herself.
For entrepreneurs, we recommend even a higher level of emergency fund, maybe about 9 or 12 months.
Maybe 1/3 of the household income actually goes to children expenses. My kids are O-levels and the PSLE, so this year the tuition fees are a bit higher, so I need to buffer and cover for that. They also attend enrichment classes.
Sometimes we do have to restructure our expenses, so it might be a bit difficult for her to cut back on tuition, but for some of the other enrichment, perhaps she could consider, because these can be big expenses that move the needle.
My father-in-law actually stopped working, he retired, so my husband kind of have to support both his parents starting from early this year. So we are making some adjustment, but well, I think we should be able to come back to, we'll be back on track at about 20 to 25% saving.
Sandwich generation is a big problem that the whole Singapore is facing right now. Always understand where your cash flow is going, that's number one. Understand what's your income, understand what are your expenses, your allowance to your parents, and ultimately for your kids as well. Make sure that both sides, as best as possible, are insured, so you don't have to worry in the event of a hospitalization or accident you can't afford to pay. I think one quick thing to add here is 20 to 25% of savings in terms of your income is actually a pretty healthy number.
I kind of paused my savings, but I'm glad that 15 years ago, I actually started to buy endowment policy. The maturity period is 15 to 20 or 21 years. So I actually buy new endowment policy every 3-4 years. So now after like 15 years, right, I have about 3 to 4 endowment policy.
So it's a very common strategy that actually our parents' generation adopted for us back in the day. But I would say today, there's a lot more opportunities to invest or save on your own with less fees.
It might actually be too conservative and it might not give her the returns that she needs. She can actually take some equity market risk, where using very low cost investments, if she understands how to manage her risk, how to manage her investments, she might actually do much better.
But again, it's something for you to consider if you want a very fast free approach to saving and you are locking up your money.
I would also say that because I started working young, I do have enough CPF whereby I use my ordinary account and my special account to invest in investment-linked policy, which I know now both of them are actually giving me some returns now.
MoneyOwl, you're not a very big fan of investment-linked policies because the charges associated with them are very, very high. So I would recommend that Sharyln and those of us with investment-linked policies take a good look and see whether they are performing up to expectations. If they are not, you might want to consider selling them off and then plowing it back into maybe CPF or some other kind of low-cost investments.
Once my business is more stable, right, I will look into more specific retirement plan. I'm actually thinking of learning how to do investment, things like trading of stocks, Forex. I'm also thinking of relook into my financial portfolio, make sure that I have enough coverage for old age.
Oh, she's thinking of learning how to do investments. Trading of stocks and Forex will have a lot of her time.
Now, trading and investments, they are not the same thing at all. In fact, trading, especially things like Forex, which are highly leveraged, they are actually more speculation. To me, it's akin to gambling. A lot of it is about the promise of fast returns, and this is not what investment is about. You can get very, very badly burnt if you are into looking to the markets to give you that quick return.
I would think for her profile, it's better to invest in something like index ETF or index fund that basically tracks the market so that over the long term, she's able to realize returns if the economy grows, and she wouldn't have too many sleepless nights about thinking whether the stock is going up or down, or Forex even.
So right now I'm also looking into unit trust investment that we can use CPF funds. There's also this Care Shield plan, CPF Life. I have not really done much research, but it will be something that I will want to look into.
She needs to understand how the CPF works and what is the function of CareShield Life, what's the function of CPF Life, because they're actually quite different things.
I think the good thing about what she just mentioned is that she wants to invest using her CPF investment scheme, but at the same time, any investments will come with risks. Otherwise, you can take a very risk-free approach and just keep it in your CPF and let it grow over time.
I'm also hoping that maybe in about 2 years or 3 years' time, if possible, business good, I can actually invest in commercial property for my own use or actually for rental yield, because I heard that commercial property, the yield is higher than residential property.
She might wish to look at her debt ratios because she could actually get overly indebted besides having to put aside a big sum of money for the initial outlay.
On a scale of 1 to 10, I would say 8. I'm actually a very driven person, so if I set my mind to do something, I will, in fact, by hook, by crook, achieve it.
That's great. I think having confidence in your own numbers, and I believe it's also because she's also a business owner, so she probably has a lot of spreadsheets at home when it comes to business, finance, and projection.
But that confidence must be grounded in a proper plan, otherwise it could be actually a fake sense of confidence, which would actually be dangerous.
My biggest challenges now is actually not knowing the market is going to be with me or against me. I need to cover my business costs. I need to also cover my children's expense. I would like to know, given now that, my current situation whereby my monies are all invested in my business and I'm not doing savings, would I still be able to achieve my retirement goal of having $5,000 cash on hand per month when I'm 60 maybe? If I can't, then what can I do?
I think she has hit the nail on the head that it is the problem of not having savings. So she needs to restructure, she needs to probably be more focused on her business and stop looking at kind of speculative moves, if I gamble it big on be it this business or be it this market or be it this trade, that it will solve my problems. And so I'll encourage Sharyln not to have this mystique of having that one solution, but actually to take a hard look at expenses, and you can achieve your retirement goals if you are disciplined and you work according to the plan that's worked out for you professionally.
And I would think one important point is to have buffer, because it's always better to plan, let's say, to retire by 55, and then you have that buffer of that 5 years before ultimately it reaches 60. It's a very Asian mindset, but I think it's a kiasu mindset that most people would have. That's how they retire earlier. Cool.